Hey everybody, it's Rob Booker. Happy holidays to you and your family wherever you are. This sponsored video comes to you from IGUS. They're our sponsor for this video. IGUS is a leading Forex broker. Check them out on the link below. All right, coming into the end of the year here, my friends, if there's one thing that's happened, I want to walk you through what happened in 2019 and how it relates so much to what happened about 10 years ago. So here's what happened in 2019. Now I'm going to start drawing a line from left to right. And when I've reached the top of the market or where you think it's going to slow down, I want you just to, in your mind, say stop, okay? Ready, set, go. Okay, you didn't say anything and the market just took off. It feels to me like we didn't say anything. We didn't stop to think about it. And the market took off with low interest rates and a Fed that was going to spur the economy, even though there's so much cash already in the economy. And tax cuts, and despite all of the problems that we're about to talk about, the market took a straight shot up for one reason and one reason only, and that is cheap money. Low interest rates created cheap money around the world. I'm going to walk you through this scenario because it's really important, because when the dynamic changes, it's going to take a lot of people off guard. So everybody here on this side of the equation has made money by buying and holding stocks that in some cases don't make money, in other cases that do make money. But in a lot of cases, stocks for companies that don't make money, and the only reason the stocks are going up is that money is so cheap. And here's what's happened. So the central banks of the world, the Fed, the European Central Bank, the Bank of England, the Bank of Canada, the Reserve Bank of Australia, the Reserve Dong Bank of Vietnam, I'm not sure that's the name of the central bank in Vietnam, what they did was they went out to banks. They went out to their member banks. And what they did was they said, we'll buy off of you your loan portfolio. We'll take it off your books. And it could be bad loans, it could be good loans. And they took those loans off the books. And they sent cash to those banks, and those banks shipped their loans, the bonds, to the central bank. What this did was it created massive, massive amounts of cash, hundreds of billions of dollars sitting in banks. What banks did then was pass along the good fortune. They passed along low interest rate loans because at the same time the central bank was doing everything we just said. They are giving low interest rates, LIR, to the banks. So the low interest rate cycle created this first scenario, which leads to banks having tons and tons of money on the books. And so what banks did with hundreds of billions of dollars over the last few years was they lent that money out to giant rich people. Not like giant people who are also rich, just super rich people and companies. And these companies and people, guess what they did with that money? Guess what they used that money to do? They used that money to buy stocks. I mean, it's just obvious what happened. And this scenario depends completely upon two things: the willingness of banks to buy those loans and the willingness of central banks to buy those loans and keep interest rates low. So where does that leave us for 2020? So what we have come to accept as investors or people that watch the markets, or as presidents or as leaders of the world, we've come to accept this scenario where there's low interest rates and there's bond buying programs, and so there's cash on the books of all these banks around the world. But what happens when central banks stop the flow of cash to banks? What happens? Or what happens when interest rates go up? In this kind of a scenario, the banks have less dollars, and in a lot of cases it is dollars, they have less dollars on the books, and then they're not lending out that money, and the whole cycle slows down. What we think has happened in 2019 is, and I've heard this said multiple times, is that this may never end. And when you start hearing this may never end, you are hearing exactly the same things that we heard in 2007 and 2008 and even into 2009 when it was obvious that things had changed. So how do you prepare for that? In a world where all of this happens, how do you prepare for a scenario where the interest rate dynamic changes, or where the bond buying programs start to dry up, or where the bond buying programs start to become less effective and they're just pushing on a string, as it's called? Whereas after a while, you can't make the markets go up any further because eventually there's just too much money and there's no place for that money to go. And eventually people just won't pay, $4,000 a share for Amazon until Amazon's dropped back a bit. So what happens in that scenario? So I want to talk about the currency markets and the stock market pretty quickly and summarize all of this. So I'm going to talk about the S&P 500, the DAX, and then the Australian 200 as well. So let's talk about these financial instruments and what happens under a scenario where, listen, there's a trade war back and forth between the US and China. There's a trade war back and forth between Korea and Japan. There's a slowing industrial production scenario in China that then comes back to life. There's a slowing economy in Germany. The European Central Bank's bond buying program can't go on forever, and there isn't enough money to buy all the bonds off of Italian banks. The Greek banks government isn't even eligible for the bond buying program. There's going to be an impeachment trial in the US. What else? What other giant potential risks to the financial system do you want? I mean, one of these things is going to break. Plus, Iran could detain a ship in the Persian Gulf. You don't know at any given time what's going to happen, but some of these things are going to happen. Murphy's Law says when someone announces that this could go on forever, you're going to be 100% sure that this doesn't go on forever. So here's what's going to happen. In an environment where everything tightens up and interest rates begin to rise a little bit, or the bond buying programs cease, what happens is there can be a temporary shortage of dollars as countries who have borrowed immense amounts of money denominated in US dollars, which is how 60% of the world's loans, even to banks and governments, are done. There can be a temporary shortage as those dollars are needed to pay back those loans. And then there can be a crash. So you could see a significant dollar increase. You could see the dollar appreciate significantly, and then you could see the dollar fall significantly. You could see in this environment, if it occurs, you will see the Japanese yen appreciate significantly. See pound yen, euro yen drop 1,000, 2,000, 3,000 pips. It's not a prediction, it's not a trade, it's an analysis, and it's an overview. If all of this slows down, the yen appreciates. And the reason for that is another significant amount of money worldwide lent out to people who buy stocks is done in yen, because interest rates in Japan are zero. When times get tough or things start to slow down, folks sell their Amazon stock and then pay back their Japanese yen loans. And what do they need to pay back those loans? They need Japanese yen. There could be the giant winner over the course of 2020 and 2021 in the currency market, stands to reason, could be the Japanese yen. So keep your eye on that. Swiss franc goes along with it, but the Japanese yen in particular. The British pound, with Brexit on the horizon and a looming negotiation between Britain and the rest of the Europeans, the British pound stands to take a giant retracement if those negotiations don't go well. Watch for this perfect storm of a slowing worldwide economy that makes the Japanese yen more valuable, and a tough political uncertainty situation in the UK that leads to a drop in the pound yen. This could be, over the next 18 to 24 months, could be, past performance is not indicative of future results, all trading involves a substantial risk of loss, but the pound yen could fall more percentage-wise than anything else in the world out there completely. So what happens to the SPY, the DAX, and the AS200? So these are separate and different in some ways, but in a lot of ways they're highly correlated to each other. And you can throw in the FTSE and others to that as well. If the world economy slows down, or if there's a crack in the system, you're going to see it in the S&P 500. It's making intraday highs. It's screaming to new highs. The relative strength index on the weekly chart is doing something that it's only done about 20 times before, which is it's in major overbought territory. That can lead to another 3 or 4 months traditionally of gains. But then when you see the S&P 500 drop 10%, what you're going to have is you're going to have a scenario where this kicks into play everything that we're talking about here, and those losses can actually spill over into other financial markets and other stock markets. But this is the kicker. Slight retracements, small retracements are pretty much not interesting. But a 10% retracement in the S&P 500 that lasts for more than a couple of weeks in 2020, if it happens, puts into play all of this, a temporary surge in the dollar and then a retracement. A massive, massive, massive 18-month period of time for the yen and a period of difficulty for the British pound. None of this is guaranteed, and all of this is speculation or analysis, but this scenario where there's enough money worldwide from central banks to keep buying the bonds that are bad, that eventually comes to an end, or interest rates have to stabilize or have to stop going low, and they can't go much further below zero without becoming ineffective. Watch for that scenario in the coming months. And I'll be here on the old YouTubes to guide you through all of this stuff. So if you liked the video, leave a like. If you loved the video, subscribe to the channel for a chance to win $100 by the end of 2019, not 2020. 2019, we'll give away a bunch of prizes. We'll give away a bunch of $100 bills. They're currently actually sitting in my refrigerator in my office next door. We'll see you later, everybody. Bye for now.